Hey guys, Whitney here. Thanks so much for joining me today. I'm going to give it just a couple minutes for everybody to join in live in the room. But while you guys are doing that, we are going to tackle the state of the multifamily market today. So if you have questions, I want you to find your Q&A box. Okay. Chat's okay, but really what I'm looking at is the Q&A box. I can kind of help organize the questions that you have and create a better flow for our conversation. So if you would find your Q&A box, if you got a question that you want to ask myself or Eric directly, we would be more than happy to tackle that into today's episode. Anyways, if this is your first time joining live, welcome. My name is Whitney Elkins Hutton. I'm the Director of Investor Education here at PassiveInvesting.com. And really, this is a live show where we tackle all various topics related to passive investing, just so to help you not only learn the ins and outs of passive investing, but really put this knowledge into use so you can confidently go into your first or next investment. Anyways, make sure that you are registered at passiveinvestingwithwhitney.com for our future masterclass sessions. You can also see our open deals and even schedule time to speak with me directly. Now, I want to go ahead and kick off today's episode and bring in Eric Fitzgerald, our Director of Acquisitions here at PassiveInvesting.com. Eric, you are a return guest, but for those of you this is their first time joining live, if you would just take a moment to introduce yourself and your role here at PassiveInvesting.com.
Yeah, thank you, Whitney. Happy to be here. Hello, everybody. Like what you said, my name is Eric Fitzgerald. I head up PassiveInvesting.com's acquisition platform. So the majority of that activity is centered around the multifamily space. I started out my career in multifamily property management during college and kind of moved into an analyst role and then as an acquisitions role, and now found my home here at PassiveInvesting.com. So a lot of my day-to-day is, networking and working with brokers on the sales side, sourcing deals, overseeing our underwriting team, overseeing our associate team, and just kind of trying to find good opportunities to have the company and our investors acquire.
Excellent, excellent. Well, let's go ahead and dive in because I'm projecting we're going to have several questions come in, kind of more of an ask me anything type of episode today. But I have a few of my own that I want to kind of kickstart us with, because this was a request from some listeners that we actually tackle the state of the multifamily market, which I think is a brilliant idea. And I was doing some digging, and according to CBRE, okay, the multifamily market saw its largest year-over-year increase from 2021 to 2022, and in both in starts and investment. So that was earlier in the year. Where do you see its position right now, mid-year?
Yeah, I think, you can look at it a lot of different ways. I think, what we have been seeing and will continue, I think, to see is that demand is still extremely strong for the multifamily space. So, renters, there's always a case to be made with interest rates doing what they are now. Buying a home is not as affordable as it once was. And now we have, especially in the Class A space, tenants and people who would normally be going and buying a house are now renting. I'm one of those people. I was looking for, a home and decided that it was definitely not the right time to do so. So, you kind of have that working as far as a headwind. And just as for a data point, absorption right now over the last 12 months is at 370,000 units, and that's still 100,000 over the historical average absorption. So demand is certainly still here. The forecasted is 308,000 for the next 12 months. So absorption is still well above historical highs. And I think we'll see that, within the next year as well.
And so when you talk about absorption and those numbers, I would naturally assume are kind of global absorption rates. Like in the particular markets we're in, is that absorption number higher or lower? Like what is the trend in the markets that we're in?
Yeah, so especially in the Southeast where you're seeing a lot of the net migration, a lot of the job growth, and even when you drill down into specific submarkets, you can see kind of where those differences are happening. And in a lot of the Sunbelt states, there's a reason why there's so much investment activity in these states. And the reason for that is because of the demand for multifamily housing. And there's been such a historical supply imbalance in the Sunbelt. Now, especially kind of catalyzed by COVID and people moving down here and jobs coming down here. That's certainly increased in the markets that we're in.
And does that trend like play into any sort of new development happening in the area? And how does that impact absorption and supply demand?
Yeah, so there's a lot of apartment development going on, especially in the Southeast, but there's still such a supply and demand imbalance as far as how many units there needs to be built to be able to keep up with the demand. If you think about the statistics of different cities, there's 80 people, for example, moving to Nashville every day. And there's probably 5 or 6 units a day if you actually drill down on the data that are actually being built. So all of those people have to live somewhere. It's not a blanket statement. I wouldn't say go place your capital anywhere in the Southeast and you'll be good to go. It's certainly more local than that. But luckily, you have people like our team and other groups that are doing the research for you to kind of figure out where you should be placing your capital.
So we've talked about a little bit about the supply demand imbalance and absorption rates. What other factors go into evaluating the strength of either the total global multifamily market in the United States, but more specifically the multifamily market in the Southeast?
Yeah, so I mean, interest rates have been a big kind of talking point recently. Everybody thinks that interest rates and cap rates are kind of a one-to-one relationship, meaning that if interest rates go up, cap rates will go up as well, and therefore property values will decrease. But that's not actually, and it's proven that that's not actually how it works. It's actually very dependent on supply and demand. So with limited supply and intense demand of capital, so capital availability, liquidity in the market, there's still tons of that going on, and there's still tons of investment activity. So even though interest rates have gone up, cap rates we've seen be pretty relatively stable. And you're not seeing in the best and final round on a property, you're not seeing that bidding go up another, 10, 15, 20,000 a unit like you did, 2 years or 3 years ago. But you're certainly, still seeing the demand from the capital chasing apartments in the Sun Belt. And then I guess another important thing would be, obviously the jobs. That's what drives our whole business. So that's certainly a little bit more local. And so I'll use Charlotte as an example. If you're, looking in Charlotte, trying to buy in Charlotte, one place that you should definitely be looking is South End, Charlotte. And that's just because, you look up South End, Charlotte, new developments, and there's office towers, there's Lending Tree moving their HQ, there's Duke Energy moving their HQ, there's all of these jobs coming in. I wish this was a teaser for a deal that we had coming out in South End. I wish we had a deal in South End. But there's certain submarkets like those that you want to be looking out for. You want to be, reading the updates on LinkedIn and all the kind of market updates, staying in touch with the brokers, seeing where that progress is happening. And now we see, I live in Center City, Charlotte, and historically has been the most expensive submarket to live in. Renter wise, you're now seeing rents for a 1 bedroom in South End, go up to, $2,200 for a, 850 square foot 1 bedroom. So, we're starting to see that here in Charlotte, and like any MSA, there's those pockets of, if you get in at the right time, that job growth is it's such a powerful wave because there's all that, high income demand looking for Class A luxury apartments. That's kind of the space that we work in.
All right. So, if we can kind of zoom out a little bit, like where does the market stand today compared to last year? Because I think there are two things. One, investors, at least the questions I'm getting when I'm holding conversations with them, they're just like, everything's so different than last year. But, I still try to help them understand the fundamentals of real estate, in that as these metrics change, that we still can adjust our business plan and, have, good profitability. And you've touched on absorption, you've touched on interest rates and cap rates, but, can you compare and contrast other parts of the multifamily market to how it was last year and where we're heading this year?
Yeah, it's certainly less of a seller's market. So like I said, the run up in pricing is not what we saw last year. That's good from an acquisition perspective. I think if you're still able to buy on fundamentals in this market with defensible underwriting, I think you're going to do very well if you're buying in the right locations in the next 5 to 10 years, and even shorter term than that. but yeah, I mean, I think it's definitely, the activity has slowed down. People are kind of, seeing what's going on. But I think there's real opportunity if you believe in the fundamentals, where like, rent growth this year is still at 9%, and the historical average is 2.5% or whatever it is. So we're still in a time of extremely strong fundamentals. I think the main kind of switch that's been flipped, obviously, is interest rates. So that's an underwriting adjustment. That's a business plan adjustment. We've got this deal in Charlotte here, this build to rent deal, where we're putting fixed rate debt on it. We might, hold it a little bit longer. Who knows? But it's those kind of adjustments that you need to make. And, we're buying this build to rent community where there's a 30-person waiting list for an open apartment at that deal, and it's 100% occupied. So buying on fundamentals like those, I think, is really important. Not getting caught up in the news and the headlines and the panicking of everybody that you see. I think if you remain level-headed, you look at the fundamentals, you underwrite conservatively for your interest rate moving forward. You don't bank on a refinance, which we never do inside of our underwriting, because there's no telling what interest rates will be when you try to get out of that first loan. So that's something I would be careful about if you're passively investing with other groups is, are they modeling a refinance, which a lot of groups are. I would dig down and say, what are your sensitivities around the interest rate, environment when you're, looking to do a refinance? Because I think, cap rates can change that, interest rates can change that, and that's a very volatile kind of subject for your returns. So those are a couple things that I've noticed so far.
No, such great advice. And then also, like, can your NOI growth, like, match pace at what you need it to be in order to actually execute the refinance? Can you actually get your business plan executed? So that's so impactful there. I think you kind of touched on something here that, people are reading the headlines, they're sensing blood in the street. Let's back it up a little bit. What would you say to an investor right now when you talk about those base fundamentals? What should they be looking at in a deal to kind of check it off in their head if it's something that would match in their portfolio?
Yeah, I would think, what are your goals as far as your capital goes? I would look for, I mean, the first place my eyes go as an investor on any offering that I'm looking at is the debt. So what kind of debt are they putting on? Are they relatively conservative with kind of where their sensitivities are at? And we always do that on our deals as far as, sensitivities on rates and LTVs and all that kind of stuff. So that's the first place, my eyes would go on an offering these days. Then I think it comes down to the location and the market. If you're buying in the Southeast in a strong submarket where there's job growth, maybe there's more limited supply. For example, this deal in Charlotte is one of the worst cities in the Charlotte MSA to get new developments done. There's been like no new apartment developments within the last 3 years. So situations like that where, the fundamentals are there. I think you can expect a little bit more upside than underwritten on those kind of opportunities, other than some of the other ones where maybe it's a, 1970s deal and it's been flipped 3 or 4 times by syndication groups over the last, 5 years, and you're kind of milking that cow. So I think those are the kind of things that you're looking at. Buying directly from developers has been a strategy that we've done really well with. I think there's going to be a flight to quality in a market adjustment. So by tenants and by investment groups alike, especially by investment groups, like institutional groups. I think in a market downturn, you're going to see Class C probably get hit just because their incomes are a little bit lower, and the percentage of their income that they're paying towards rent is typically the highest, closer to that 30 or 40%. And in our deals, we're seeing a lot of times, 20%, 24%. So I think we have a little bit more room on the income versus rent ratio there. So that's another thing I would look at is, the vintage, the quality of the asset, because eventually your capital, you want, a liquidity event by a sale eventually. So who's going to be buying that on the back end? Is it going to be, are there going to be 7 institutions, in the best and final round that are all, want your asset because, it's an institutional asset in a core market, or is it going to be, a couple of syndicators and, a family office that maybe aren't as aggressive and not as widely spread?
Hmm. So I want to kind of throw the crystal ball question out at you. Because we've been throwing out the words inflation and recession, and those two words tangled together quite a bit. Talking about them in various presentations here on the Masterclass. I know I've been invited to several speaking groups to talk to investors about those two topics. And how does that play into our business plan right now and where we see our business plan going in the future?
Yeah, I think making sure I'm moving towards like a return and number answer. So I think looking at your exit cap rate ranges, I think betting on cap rates expanding, you should have always been doing that, but I think some people maybe got away with maybe not doing that in the last, this last cycle. So I think making sure that as an investor, you're vetting, where is the entry cap rate on this deal? Where is the exit cap rate on this deal? How are my returns being calculated? Because I think maybe there's some groups that got away with doing some of that sort of stuff in this last kind of late part of the cycle. So looking at cap rate expansion, that's always a good way to hedge against any kind of property value, decrease, any kind of job market shift or recession, environment. I think another thing would be looking for investments with diverse economies. So maybe looking at how, those MSAs or those submarkets performed during 08, 09. Now, a lot of those markets may have changed quite a bit and diversified quite a bit since 08, 09. Like maybe there was a market that was very dependent on banking back in 08, 09 and got hit pretty hard, but now they've kind of diversified a little bit. So making sure to kind of take that into account, but definitely looking at job markets with, diverse employment. Again, looking at incomes versus rent. So, first, where is the median income in the area? And then what is the average rent on your property? And you don't want to have your area monthly income. You don't want to have your rent be over 30% of the area median monthly income, just from an affordability standpoint. And I think especially within the Class A space, you're already probably seeing a lot of the would-be homeowners now moving into apartments, and that's certainly what happens in a recessionary environment as well. Is kind of moving down from the homeownership to Class A apartments.
So I want to ask kind of one more crystal ball business plan question before we open it up to Q&A. So if you guys have a question right now, this is an amazing time. I'm going to direct you over to the Q&A box, start putting those in so I can open up the floor for Eric. But as you mentioned that, the upward pressure on rates is potentially, taking would-be first-time homeowners, potentially like yourself, and, encouraging them to either, not look for the house because they can no longer afford it, or just to kind of stay put for a while and ride out the current environment. Do you have any sense on how long this particular trend might last, and what are some cues that it either might get worse or it might be getting better?
Yeah, I think, it seems to be pretty inflation driven. So all of the kind of rate increases, I think everybody's kind of watching that inflation data to see what happens with it. Maybe if that gets, kind of hit down a little bit, maybe they'll kind of reverse course a little bit and bring rates back down.
And they being in the Fed.
Yes.
Yeah. Okay.
There are 1,000 different, scenarios that could happen. I think my own personal view as, a passive investor and as, the director of acquisitions here is just, like I said, buying on fundamentals, making sure you have your exit cap rate expansion. So for those that don't know, just, every dollar of NOI is valued a certain way. So expecting that same dollar of NOI, of net operating income, by the end of your hold period to be worth less than what it was at the front end of it. So it's a little bit more of a conservative viewpoint on your sale, depending on the economic environment that you might be in, and the kind of sale environment that you're seeing.
I
So
love that. I love the back to fundamentals piece. That's what I've been talking to investors about. I kind of feel like a broken record, but at the same time, really you get back to basics, right?
mhm.
You know, and so I really can appreciate that and I can stand behind that. So we had a question come in from a listener. Which real estate classes have elevated risk at this time versus which ones are quote unquote safer?
Yeah, I think the Class C space has been um, bid up pretty aggressively in this later part of this last cycle. So Class C meaning, 1960, 1970s, even into 1980s type of assets. We've seen, that's where we started. We've since sold those assets. I did a couple, C class investments of my own. I think there is probably still a place for them if you're finding the right opportunities and you're in the right space. But the cap rates on those C class deals became, in some cases, even more compressed than buying a new development deal from a developer. And at a certain point, there's a risk reward scenario there where, if you're paying a 3.5 cap for a 1970 value add deal, and you can go pay a 4 cap for a 2021 lease up deal from a nationally recognized developer in a core city, that becomes a little bit of a misfire, in terms of how you're thinking about investments. So I think that space, I would be hesitant. I'm not saying there aren't good opportunities out there. There are great operators out there that work in that space and that know that space and do that space very well. And it's seen an incredible amount of success over this last later part of the cycle. It feels like to me, you're banking on a lot of appreciation on those types of deals and not a whole lot of cash flow. And I think that's a little bit less viable here moving forward as far as an investor goes. I'd say the Class B space, I like. The Class A space I really like, just because of that natural trickle down from homeowners. The incomes, like I said, a lot of the median incomes on the properties that we have are 75 to 125,000, and those people are not at risk, as at risk as a Class C resident that maybe makes 35,000 household income and is already paying 1,400, 1,500 a month for rent. That's a little bit tighter on the budget there.
Mm-hmm. Can you elaborate a little bit more on, I don't think everybody's aware of this, but I was super thankful, when I learned this years ago, because I first started off with passive investing as an investor. 2018, I think, yeah, one of the originals. Anyways, but what is our tenant underwriting process? Because I don't think everybody is wholly aware that we actually do that.
Yeah, so we'll go in and do a full demographic study on our resident base. So we'll put together where they're all working as far as companies goes. We'll group them into industries. We'll group them into incomes and age as well. So we get a really good idea of who's living on the property, where are they working, how much money do they make, which is very important. And that's typically something at a high level that we like to do even before we acquire an asset. So we'll get a resident demographic report in Excel, and it'll show you, employment data, salary data, where they're living, all that kind of stuff, and what they pay for rent. And we typically don't want to see, like I said, that 30% or higher. Typically we're seeing 20 to 24% that our residents are spending on rent every month as part of their monthly budget.
So we're not guessing, we actually know.
Yeah.
Awesome. Another question came in, and maybe it's something you can answer. Otherwise, we can table it for the after party. Is hotel to multifamily conversion opportunities seem to be flooding the market now? Any thoughts on investing in these?
Yeah, I have seen a good number of those recently come out. I think there is a good story there as far as replacement cost goes. So if you can buy, an existing asset at, 90 or 100,000 a unit, you're typically not going to be able to build that same product for that price, even after putting in the renovation costs on a hotel to convert it to multifamily. It's a good kind of replacement cost play to where you end up with a fully renovated typically studio type apartments just because of the nature of the hotel room sizes. But there was one up here in University City in Charlotte that somebody did, and I thought they did a good job with it. It was all studios, so and it was right by a hospital, so there was a lot of traveling nurse type of residents on shorter term leases. So I would definitely pay attention to the basis as far as the price going in and how much wiggle room there is to overspend on renovation, because you probably are going to do that on a project like that. But I think it could be a good play as far as getting into a good location where it makes sense to have some of those more micro, smaller type of units, and eventually you have a fully renovated complex for lower than what it would take to build that same complex in that same location.
We're actually seeing some of those type of conversions here in the Denver metro area, which are very interesting to me.
Yeah, yeah,
So,
yeah.
I'm like, oh my gosh, 400 square feet. But I mean, sometimes when I look at my house and everything that's in it, I'm like, that's appealing.
Yeah, that's right. Yeah.
All right, guys. I'm just being very respectful of the time. For those of you who are joining live, don't go anywhere. We're going to wrap up this live section of our show here in just a second. But join us for the Ask Me Anything after party. Eric, before we wrap up, I have one last question. What are the biggest takeaways? And maybe you'll be reiterating something you've already said, but that you want listeners to get from this episode as they look at the multifamily outlook for the remainder of 2022?
Yeah, I would say, going back to fundamentals, of course, but I just think, we're seeing 9% projected rent growth organically this year. That's 6.5% above any historical average previously, aside from last year where it was 12 or 13 or 15% or up to 30%. But I think the supply demand imbalance is still there. Vacancy rates are still at historic lows, so your apartments are still highly occupied. There's a plethora of residents and tenants that want to get into apartments. Mortgage rates are rising. That brings more homeowners to multifamily. I don't think you can paint a broad brush and say, go invest in a multifamily complex in the Sun Belt and you'll be good to go. I think it's certainly more nuanced than that, but I think it's still a good place to be. The fundamentals are still there. And I think just on a case-by-case basis, watch closely on what debt is being underwritten, where the exit cap rates are on the investment offering that you're looking at, and where's the submarket and market job situation and job growth. But I think if you kind of stick to those things, you should be able to weather the storm and then, ride it. If there is, a significant downturn, then ride the next wave up. So that's what we plan to do.
Awesome. Well, Eric, thank you so much for joining me today. Don't go anywhere. We'll execute our transition into the after party here in a moment. But for those of you joining me live today, thank you so much for spending your most valuable resource with me, which is your time. And not only to invest in yourself, but also to be with us here today. Be sure to register at passiveinvestingwithwhitney.com for future masterclass sections and to check out our open deals. And guys, we've talked a lot about multifamily today. This is not a solicitation, but if you're interested in taking a look at our 2 multifamily deals that are open, be sure to reach out to me directly and we can have a conversation about that. Guys, thank you so much, and we'll see you next week.